Our names are Paul, Matthew, Nathan, and Elizabeth, and we are in the technology sector, and our company is Amazon. Today we'll be talking about the company background, business segments, financials, growth opportunities, valuation, recommendations, and a closing summary. First, the company background. Amazon was founded in 1994 by Jeff Bezos. Their mission statement is to strive to offer our customers the lowest possible prices, the best available selection, and the utmost convenience. Amazon is the world's largest online retailer and is growing in a broad range of businesses. Their core business is e-commerce operations. Amazon works in retail, subscription services, and web services. Retail is Amazon's key source of revenue, with online stores accounting for the largest share. Amazon's business segments include North America, International, and Amazon Web Services. Amazon's North America segment holds the most net sales, accounting for 63% of the company's net sales. The key source of revenue for North America is subscriptions, including Amazon Prime. The international business segment includes Amazon's retail business for consumer products and subscriptions for internationally focused online stores. The segment incurred net sales of about 25% of the company's total net sales. Amazon Web Services provides services to businesses, government agencies, and academic institutions to deliver content and store information. Net sales for this segment make up 12% of total net sales, and operating income comprises 57% of Amazon's total operating income. Now Paul will talk about Amazon's competitive positioning.
Yeah, so strong competitive positioning in a thriving industry. The graph on the left shows the past and future projected growth within the retail e-commerce industry as a whole, and there's been very strong pandemic and store closures. But there's strong belief that people aren't going to be rushing to the stores. People were forced to hop online to it, but then they fell in love with it. So a lot of people think, and even without that, we're up through 20. Back on the right is Amazon's sales growth within the e-commerce industry throughout that time, and Amazon just has continued to outpace the rest of the market by staying ahead of the game, and has benefited from improving things such as already the in delivery. Pre-pandemic, Q4 of 2019, saw more people join Amazon Prime ever before. In 29% of U.S. e-commerce sales leading the industry, and the second highest was eBay at 6.1% Q. And now Nathan's going to talk to you about the financials.
Okay, so Amazon has some interesting financial numbers. Their attempt is to be a high growth company, and they've been successful at that for quite a few years now. That's why you see that high PE ratio of 91.62 and PEG ratio of about 1.22. We would hope to see that PEG ratio be a little bit lower, closer to 1 or less. But with the current year's growth model, it has grown a lot quicker than we expected this year. Price to book is 27.12, return on equity 21.95%, assets 5.14% return on those. And so that leads them to an overall net profit margin of 4.13%. They have relatively high growth costs. As I stated before, they've been making an attempt to continue growing for quite a bit now. And so that's what's leading them to that lower profit margin of 4.13%. Along with that, we can compare this to some of their competitors in the industry. If we're looking at eBay, eBay has some much different numbers than Amazon, as you can tell straight away looking at it. Their PE ratio is a lot lower, and they have a lower PEG ratio. as well as the overall profit margin is a lot higher. And the reason for this is that they don't have those costs associated with growth that Amazon is incurring, trying to get into more markets and continue moving forward. So the industry average for the online retail sector, which is a pretty broad sector, all online e-commerce and that kind of stuff, ends up having a profit margin of 9.44%. And like I said, Amazon's still trying to grow, even though they own a significant portion of the market. But I will let Matthew go ahead and start speaking about those growth opportunities that we were talking about.
Matthew, are you there or you muted?
I had myself on mute, my bad. So these are the growth opportunities. And to start, we're going to have the Amazon streaming services, but we wanted to focus on the music. So that's going to be an additional $79 a month for anyone that has a Prime membership. And then following that, the Amazon Pharmacy, which they just recently introduced in November. And basically that comes after their purchase. It was like a $750 million of PillPack. And so basically what that's going to be is they're going to offer a service where you are going to purchase multiple prescriptions, and then it'll be delivered to Prime members on like a day that they have requested. And then Amazon Fresh is kind of similar to the pharmacy, but it's just dealing with grocery services. Amazon Day, that's going to also, it's delivery service where you can order products on the same day as you choose. And then kind of, as we said before, the web services, it's a cloud-based system that's gaining a lot of popularity right now. And then lastly, trying to expand into more brick and mortar stores just so they can have like a more physical presence. And then we wanted to focus on the two I said before. They were like the Amazon Pharmacy and the Prime services. So we got those numbers by, so we took the PillPack market share, which was 0.0023%, and then we multiplied that by the total market share, which was like 1 million. It was 1,430.5 billion, which that was the U.S. pharmaceutical delivery service share. And then we would that would eventually come up to the market share that PillPack or Amazon owns, which came out to be 247,319 or 247,319,000, sorry. And then so after that, we took that number, multiplied by our growth rate, which we said was going to be 4.27%. And then we decided that number because we expect that to have we expect the pharmacy to have similar profit margin to Amazon. And so the total is going to come out to 10,560,521, as you see in 2020. And then following that, you're just going to multiply that year's number times the growth rate. And then that answer is going to be added to the 2020 year, and it's going to follow through there. And then for the Prime Music, how we found that calculation was we took the total amount of subscribers, which was 39.4 million, and then we multiplied that by the Prime Music cost, which was the $79, as I mentioned before. And so that's going to be a total of 3,112,600,000. And so then that number, as I said before, is multiplied by the Amazon profit margin of 22% to get our revenue, which would be 684,772,000. And then that's multiplied by the growth rate, and it kind of follows this same process as it did before for the PillPack. And then for the EPS numbers, we took the current EPS, which is 34.15, and then you multiply that by the 17.2%, and then whatever that number is, you add it to the 34.15. And then following that, we have the valuation. So basically, we chose the price earnings method because we felt that it was just a better option for Amazon given like the circumstances we're working with. And so the current price today is $3,155. And so the reason you're seeing like the negative numbers in there is because Amazon has that high amount of capital spending. They increases in net working capital, and then they also they'll rapidly spend a boost expansion. And then I'm going to hand this off to Paul.
You guys can hear me, right? I have a bad network quality, so hopefully that is hindering you guys from hearing me. But so now we're going to talk about some of the key risks are presented with Amazon, and the 7 that we identified are competition, profit uncertainty, slowing revenue growth, speculative valuation, succession, and then regulation and antitrust laws. And I'm just going to touch on 3 of these real quick, and we're going to start off with succession. And we identify succession as a high risk, first off, high probability risk, because succession, Jeff Bezos is bound to step down one day. He can't run the company forever. And the reason we see it's a big risk is because since 1994, when the company was founded, there's only been one man at the head of Amazon, which is Jeff Bezos. And he's seen as, one of these once in a generation minds that is just always one step ahead of the game. And there are a long line of executives that are in place to take over once the day comes, but also somebody that was seen, Jeff Willick, who was someone who was seen as the most likely next in line, just announced that he's retiring. So there's definitely a lot of uncertainty within who will take over after Jeff Bezos. And the second one we had was competition. Competition is inevitable, especially in an industry that is growing the way it is and just has so many people that want to get into the ball game. So there's people like Walmart, Target, eBay that are just, these companies pretty much just have game plans to attack Amazon, not attack them, but just compete with them. And companies, especially Walmart, have been gaining. There's still no serious threats to Amazon's market share. They're very far ahead, but there's been serious growth within companies like Walmart. And the last one we'll talk about is regulation and antitrust laws. A company with such a high market influence, such as Amazon, is always in danger to regulation and antitrust. Luckily for Amazon, they do have their low price offerings do make it harder for antitrust laws cases to be brought against them, but there's always a chance of it. So yeah. Now we're going to talk about the fund correlation with Amazon. And over there. And we found that there were no strong correlations, and a category's correlation is 0.7 or higher. The 2 highest correlations that we did found were with Google and Adobe that were pretty identical, around 0.62. And other than that, middle of the road was Apple and Facebook were around 0.5. But then other than that, we saw most of it was around 0.35 to 0.25 range, so pretty low correlations. And the lowest that we did find was Next Era Energy, which was 0.00831, which is by far the lowest that we found. There were no negative correlations with Amazon in the fund. So, yeah. Now I'm going to pass it on to Nathan, who will deliver our closing summary.
Okay, so overall, what we found with Amazon at their current stock price now, I will note that this is a little bit lower. As of right now, it's right around $3,100, which, it's not super significant, but it is a change. They do have that high PE ratio and that goal of growth. And with that goal of growth, we did give them a target rate of return of about 10% over the next year. So by November 6th was when the 10% was calculated. We use numbers from November 6th in their data. So we found that the target price using the PE method was $3,500 there. And so that leads us, with the amount of risk and those lower future cash flow numbers that we saw earlier, we're not recommending a buy. We're just going to recommend a hold for right now. I do see the reason for recommending a buy. However, with the current valuation of them and the virus that's been plaguing the world, it has skyrocketed. So the current recommendation that we're offering is a hold strategy. And then I'll open it up to any questions that you guys may have or any comments comments or concerns that you may.
So I just want to remind our guests of a few things, and then we'll open up to questions. So for the faculty and the board members in attendance, if you'll remember the link that I sent to score the presentations, and probably best to score as we go. If you'll fill that sheet out as we go. So we can have about 20 minutes of questions. We do have a bit bigger audience than normal, so maybe we should try to keep it to one question each, so we can let as many people ask questions as we can in this 20 minutes. And also maybe if you would, follow up after your question, maybe kind of give your thinking or why you're thinking of that question, just so the students kind of see what your line of thinking is. So with that, I'll open it up to anyone that has any questions.
This is Tyler. I can start.
Yeah, go ahead.
If we could go to the slide where you talked about your correlation. So if we're going to buy Amazon, needs to fit into the portfolio. You talked about the correlations with the companies within. I didn't catch a definitive conclusion. You highlighted ones with higher correlations or lower correlations, and pointed out that there was nothing with a negative correlation, which makes sense. There's some correlation, just equity to equity, for lack of a better term. Where do you feel that adding this? Do you feel like we would need to sell anything? Is there anything that you think in particularly that we'd want to replace, where this is a better use of our capital to buy Amazon than to continue to sit in something else? So to the person, I guess, that was talking about it within the context of the portfolio, maybe if you don't mind just kind of letting me know why you think it's a good fit, and how is it a better use of capital than some of the other things that might be in the portfolio today.
So we did find that the Amazon stock didn't have any significant high correlation, so it would be a good fit as far as if we're looking for stocks that are going to give us a lower risk. I believe, not like we said, there wasn't anything with a negative correlation to Amazon, but it kind of fits with what the fund's goals are. Since we're recommending a hold strategy, we didn't have any particular stocks that we were looking to sell. I'm attempting to bring up my personal recommendations on the portfolio. I know we had an assignment where we did look into that, but it'll take me a moment to pull that up. So if you give me just a second, I can find it.
I can talk a quick about my thoughts. So
Sure.
like Nathan said, we kind of decided on a hold, so we didn't look as in depth. But then we did see there were two companies that had very high correlations, so we thought maybe replacing Amazon with that if we were to buy, and that was JPM and I forget exactly which two those were, JPM and Prudential. So those are two that we saw there throughout the whole fund. There weren't any high besides those two. Those were pretty strikingly high. So we thought one of those, maybe looking at, if we were recommending buy, we probably would have looked further into one of those, which maybe we could have sold to use that capital for Amazon.
So it
like
correlated most highly with the financials?
On the correlation matrix, those two were the most highly correlated.
Interesting.
And that was a correlation of 88.87.
Yeah, so I was just looking over my notes, my personal notes. Now, obviously, this isn't part of what my group did, but my recommendation was to remove some of Prudent Financial. I'm looking at their history. It seems like they've had a pretty low growth rate, and if we're looking to keep up with the S&P 500 with this fund, that might not be the best place to be. Now, I didn't look. I don't have their stock information pulled up in front of me, but that was my personal recommendations on that. So if we were to buy some Amazon, that's one that I would look into selling, and not in any particular reason related to the correlation of Amazon with that stock, mainly that the stock was not performing in the way that we would like to see it.
Okay.
Can I ask a question? I'll follow up on the Prudential. So Prudential trades at a PE of 8, and this is at 91.
Yeah.
Please tell me why every dollar of Amazon's earnings are worth 9 times as much as, or 10 times as, 12 times, almost 12 times as much as Prudential's. Just think about that. Every dollar of Amazon's earnings, for some reason, you'd be willing to pay $12 more, 12 times as much as Prudential's. And by the way, Prudential's up about 100% from the bottom.
Yeah. Yeah.
So, and by the way, it was one that I considered buying personally. Unfortunately, I didn't. My dad did. He made 100%.
Well, that's wonderful news. It's always nice when you get a good gain like that.
In this boring no company. So now you have to figure out why is Amazon worth, and then maybe just tell me why. What do you think? And everybody answer, because basically, if you just took it versus the average company, you would actually have to say we're 4.5 times better than everybody else. Why is that? It just average. It just so happens Prudential is really cheap, and the average company is trading at about a 20 PE.
Yeah, I understand what you mean in that regard. I was looking at the more long-term aspects of Prudential. I realize the short-term gains are definitely there to say that you should buy it, but in any regard, the reason that I would pay more for Amazon is their growth potential as well as their current market share and the direction that the company appears to be going. Even with Walmart and Target and eBay attempting to take up their market share, Amazon currently continues to hold as the go-to place for online shopping. Anyone who wants to search for a good price on something, usually the first place they check is Amazon. And then if they were to do another search, they would probably search Google. And Google, another good company I would recommend. But Google would probably lead them to Amazon for their purchase. So that's why I see Amazon as being worth a little bit more in that regard, and actually a significant amount more is because they hold.
Good, because it's not a little bit more. It's 12 times more.
Yeah.
Okay, so I won't ask just because there's others. I won't ask more, but if others don't have more, I will.
I have a question for the group. If you could go to the slide where you show the different segments of revenues, please. Thank you. So yeah, in the pie chart, it looks like the web services is 12% of the sales, but I believe it was mentioned by someone that it makes up 57% of the operating income. So as an investor, we're ultimately getting compensated for the profits of the firm. So, revenues are nice, but if they're not turning that into profits, I don't care as much. So that 57% of the operating income, when it only represents 12% of the sales, is attractive. So I was wondering if you looked at the distribution of growth between these segments and their importance to profits ultimately. And if that was factored into your decision at all, or some of your estimates. Whereas if the web services is a growing component of their sales and also representing a large portion of their profits, that's something that's of interest to me as an investor, as opposed to a fast-growing retail segment that's not really generating much profit. So I guess the question is, did you look at the different sales or different growth rates between these segments?
Yeah. Yes, we did. Go ahead, Paul.
Yeah, so AWS Web Services is actually one of Amazon's strongest revenue segments right now. It grew 29% in the third quarter of 2020. So this is definitely something that we saw as something that's been growing a lot. So I don't know, Nathan, if you want to touch more on that.
Sure. Yeah, we've seen Amazon's web services grow significantly in the last couple of years since they started implementing it. They've been doing a ton of different things with it, and by different I mean they've been doing different. They've been choosing a different method of doing things. So, for example, they have something that they call the snowball. It's something that no other business has done in the segment, and they essentially a shipping container. Which is full of servers. And this shipping container, the reason that businesses might need this is, say that you've got a large bank, such as like BMO Harris, and they want to go over to Amazon Web Services to manage their data, rather than doing it on site where it might cost them more. When they have that, they have petabytes of information, like hundreds and thousands of petabytes of information, which is, thousands of terabytes on top of that. So these snowballs alone carry tons of information, and they can transfer data faster than most internet can. So they'll be able to plug this semi-trailer essentially into any building, and they can ship it anywhere in the world to be on an Amazon server within days rather than within months that it would take to transfer that kind of data over to a different server from a different company. So we've noticed that the Amazon Web Services have grown significantly. Along with that, it's also one of their most profitable and revenue intense segments. So like we said, it's over half of their revenue comes from web services, even though it makes up 12%. And within the last year, it has grown significantly.
Hey, Adam, how many minutes do we have left?
9 minutes for
Okay.
questions.
Can I have a follow-up question to that? I think Brandon's question was spot on, and this actually won't be my question. This will be Brian Wilmette's question. He asked for this one. If it's such a huge web services being such a huge important piece of this kind of story, I'm curious as to why you chose to focus on like the music, which doesn't, in the next slide, it doesn't really seem to move the needle. Or I guess the pill pack is interesting, but again, I think it's people kind of do the analysis, which you just did a great job of talking about AWS. And to Brandon's point, that seems to be the growth driver. I'm curious why you didn't focus on that versus, again, kind of the music and maybe the pill pack, which there's still some speculation there and it may not move the needle as much as like the AWS. And again, that's Brian Wilmette's for the record.
Yeah.
Casey's got one too.
Well, we understand that AWS is a significant portion of Amazon's growth recently, but Amazon's always looking for the next growth opportunity. And so we attempted to research them in a way that would follow more of their business model of always looking for the next big thing. So that's why we looked into the music industry portion of things, where they do have a higher margin in that. And PillPack is a brand new thing that Amazon started offering. Amazon Pharmacy just came out this year, I believe, or late 2019. But we focused on those because they're the newest segments, and we believe that there's growth potential there on top of the Amazon Web Services. So we can clearly see that the Amazon Web Services makes up a good portion of their revenue, but we think that in the future that will be just a small or a similar piece of the pie, I should say, not any smaller than it currently is, really. But I think that we think that Amazon Pharmacy, as well as PillPack, which is their acquisition that kind of started the whole thing, will allow them to grow at similar rates as Amazon Web Services has.
And adding to that a little bit, I mean, I feel like there's definitely some ways you could have gone, and back at AWS definitely was a great option. But our thoughts at the beginning were just the numbers that we saw with the growth for Amazon Music. I mean, they were up users like 100%. I think the number we saw was 104% increase, especially nationally. I think that was something, or not nationally, globally, something that we saw internationally. Their increase with like Amazon Music subscriptions was just water growth. So that's definitely something that we saw with the revenues for increases in their Amazon Music. So.
All right, I can understand that piece, but I think that maybe Kevin would speak more eloquently about this more than I would. I think one of the things that you guys later in life kind of step back and as you're doing these similar kind of projects, those smaller areas of that kind of up and coming areas, like I had mentioned, you might see rapid growth there, but when it comes to just the overall size of an Amazon, you'd have to almost really do a deep dive into how is that, what kind of, at what level does that actually really materially increase the underlying, earnings per share of the company or the overall, sales growth. For lack of time, I'll stop it there. But I think Eddie's question was on slide 10. If you can move over there. This is just a number thing. Very quick. Oop. So in the last part, this is just a real quick thing that I noticed, and maybe it's because of timing, but if you go to the right, Eddie had noticed the combined target price for your baseline is actually less than your low growth. I don't know if you guys can speak to that really quickly, and then I'll ask my big philosophical question.
Yeah, I believe that is a timing mistake. We've been working on this for a few months now, so numbers have changed since we began this back in early October. So.
Okay, nope, that's understandable. I just wanted to point that out. And then I guess lastly, this will be my question, and it's more of a philosophical question. I'll start out by saying I commend you guys for using a hold rating on Amazon. I think a lot of people historically, when they come in, classmates similar to yourselves, they come in picking a stock, and they're really trying to make it fit so they can put a buy tag on it and hopefully get it into the portfolio. So again, I'll commend you on that. As you guys were going through this process of the valuation, again, this is more philosophical. Did you ever think, okay, at what valuation it might make sense, or potentially at what price would the board want to come back and say, hey, you know what, maybe at this price it might make sense?
Yeah, so I want to make sure.
Go ahead.
You can speak, Paul, if you're going. But anyways, I want to make sure I'm understanding your question. So
yeah,
wondering at what price would we say that Amazon is worth if we were going with a similar to the market kind of approach, or?
Well, I mean, at the end of the day, you said you had a couple of different options, right? You said you could a couple of different recommendations. You could say, board, we suggest that you consider buying this for the fund, and that would probably be because you saw, despite the high PE ratio, you saw an overall growth projections that might make that valuation over time become more palatable because it would grow into it. You decided to say, you know what, let's hold the stock, not actually buy it. So you're saying there's a valuation argument, if I'm understanding what you're trying to argue here, that, hey, you know what, the price is, there's not enough upside, right? Compared to where it is currently. So my question is there a value or, either a combined target price that you would say, okay, it makes more sense here, or, some kind of valuation, I guess from a PE perspective, or whatever PE or, price to book, or whatever valuation metric that you wanted to see happen. Like you at some point there's a line that was crossed that went from, hey, we want to buy this, to, hey, you know what, we're going to hold, or vice versa.
Okay. Yeah, I'm understanding the question a little bit better. So the reason that we gave it a hold strategy was mainly because when you look at these future cash flows, them being negative, Amazon seems to be spending money faster than they can get it in most regards. They're usually in the name of growth. So it's not like they're not seeing the money come back. They have in the past, but it is a significant risk compared to what you might see in other businesses where they're not investing so much in the growth as they are in improving what they currently have. So we, with these lower price targets, so with the low growth and the high growth you see there, when we came up with our overall target, even though it was that 3,500, that was a pretty wide margin that we had for the growth strategy there. And we didn't, the reason we don't really want it is there is potential that there is significant growth in this market in the next year. With the pandemic and everything, things in the online sector have grown significantly, mainly because they have to, mainly due to government lockdowns and not being able to purchase things at one of your local stores. So with the reopening of the economy that we should see in the next year, you could see people migrate back into that brick and mortar area a little bit harder than you've seen in the past. So you might see a significant amount of people actually purchasing stuff at the store and like going out to the malls rather than shopping online, because they have been doing it for 9 months now, and we've seen that from their previous growth. So I'm not sure that the next year in particular is going to be it's going to be any significantly higher, and so that's why the low growth, we ended up with that 3,200. It's not enough to claim that we should buy it if it does end up being one of those low growth years.
Yeah, like Nathan was talking about, it's not as much as a current pricing for us. It's more of a timing thing, especially when Amazon plan to spend $4 billion in coronavirus related spending in the fourth quarter of this year. So we just look at that and the amount of money they've been spending. Like, they've been spending not only that, but the amount of money they've been spending on rapid expansion. We just saw that as just kind of a warning sign. It's not something that told us we're scared of Amazon, but it's just, that's why I recommended hold, because it's just something where just a lot of unknowns for us.
Okay. No, thank you for that. I think the learning point for you guys to think about later in life is that I think if you were on earlier, they talked about Salesforce buying Slack, and at the end of the day, if you guys get into finance, you're gonna have to make these kind of buy and sell decisions, and there's going to be some point that you're going to make a decision that yes, we're either going to go ahead or no, we're not going to. So I was kind of curious as to if you guys are kind of working on that now. So again, kind of a learning, something to think about moving forward in your careers.
All right. Yeah. So we should probably, unfortunately, cut things off there for the Amazon group. So good job. You can stop sharing the PowerPoint there, but since we're about 7 minutes over now, we should probably go ahead and move on to our next group. So whoever from that group would like to share the PowerPoint, and then you guys can get started. Okay, whenever you guys are ready.
Alrighty. Good afternoon, everyone. My name is Mariah. Presenting alongside of me is Sam, Jaron, and Eli, and we are representing Group 6 today. And the company that we have followed and analyzed throughout the semester is Innovative Industrial Properties. The most current stock price as of today stands at roughly $160 per share. The current PE ratio trailing 12 months is roughly 49. And the target price is about $198 a share for the 1-year estimate. Following this, our target return is 24%. And overall recommendation for the portfolio is a buy. And we will further discuss our reasoning for this throughout the presentation. Here's just a brief presentation outline to guide the research and the listening. I just provided a brief summary of some of the initial key financial numbers just to introduce IIPR. Next, I will dive into some company background and information. We will then further discuss business segments of the company, some of their revenue streams, and then we will dive into some of the financial numbers, financial ratios and such for IIPR. We will then move on to growth opportunities and key drivers of the company, then discuss valuation and some of our valuation methods. And lastly, we will finish with a recommendation and overall portfolio fit for the Spellman Fund. So just some background information on this company. Essentially, what the business goal of IIPR is that they focus on purchasing properties that are suitable for the legalized growing of medical use cannabis from certified and legalized growers. And then they focus on leasing them back to these specified facilities. So kind of the main takeaway, if I could describe it briefly, they focus on the acquisition, ownership, and management of the properties that they're working with. The company was founded in December of 2016, so it's been 4 years now, and the company has seen tremendous growth and opportunities, which we will also discuss furthermore in our presentation. Going off of this, the company currently holds 61 properties located in 16 states across the country. And also, as we'll discuss later, this number is very contingent on increased legalization at both state and federal levels, as well as some other election results. So the company is definitely hoping to capitalize on expanding production based that we might see in the near future. The average lease term that they work with their partners is 16.2 years. With this being said, the company does have a very diverse range of tenants. They look to work with companies that are well capitalized, have healthy balance sheets and income statements, among other things, and of course are comply with both state and federal regulations for their growing practices. The company continues to utilize sales leaseback structure, as well as expand partnership with new tenants and maintain those relationships with their current tenants. The company is a part of the REIT industry, and actually right now they are currently the REIT that use cannabis facilities. So that's another thing that kind of makes them a REIT. And the company is known for having significant dividend payout to shareholders. So this is a very suitable stock for those investors that look to capitalize on dividends. The quarterly payout has increased by over 680%, so about $1 since their first cash dividend payout in 2017. And their annual dividend payout yield is roughly 4%. And now I will hand it off to Eli, who will further discuss geographical sectors.
All right, thank you, Mariah. So I will be going over these geographical sectors that Innovative Industrial Properties operates in. So they are only based in the United States, which the states they operate in are listed here. So they don't list their revenue per state, but they do list their investments per state. So I won't go over every single one, but the percentage of the total portfolio is in the parentheses next to the states listed, with the total investments totaling to $1.2 billion across the United States. So I'll be moving on to this pie chart here. Here you can see a major portion of their investments go into Illinois, Pennsylvania, Massachusetts, and Michigan. So moving on to Innovative Industrial Properties financials, as you can see, they're laid out here. So the price to earnings ratio the last 3 years have been good, with the just about 80 in 2018, 52 in 2019, and 49 currently. Now this is trending downward, which is good. We expect earnings to continue to increase as time goes on, so this number does kind of feel justified. Investors often considered a price to book ratio below 3 kind of good, and innovative industrial properties price to book ratio only exceeded this benchmark 3 years ago, 2.24 in 2018, quickly turned into 2.2 in 2019 and 2.64 currently. So kind of shows that IIPR has a good value for its price. Now, earnings per share shows a constant growth in the last 3 years, growing from only 75 cents in 2018 to its current price of 2.33. Now, the numbers here over here on the right side of the slide show the operating performance of IIPR. So I'm not going to go over every single one. They're listed for you there. I'd like to focus on their debt to equity. They do use more debt than they do equity. And finally, their PEG ratio. Based on our analysis, we came to project their PEG to be 6, with the industry average being 7.78. So I think, and my group thinks also, that all these ratios indicate a healthy and expanding company with plenty of opportunities to grow, which Sam will now go over.
Thanks, Eli. So I'll be going over 2 main growth opportunities that our group really thought that would benefit IIPR. One of those growth opportunities includes the legalization of medical use cannabis across the states. So currently there's 35 states that have legalized medical use marijuana. This includes the most recent 5 states that just joined during the election. There's also talks about potential for federal legalization. About 6 days ago, the U.S. House of Representatives passed a bill removing marijuana from the Controlled Substance Act. So, but even though the bill was passed through the House of Representatives, it still has to be approved by the Senate. The Senate's controlled majority by Republicans right now, so it's not looking super optimistic currently, but there's 2 candidates running democratically for Georgia on January 6th, and if they get approved into the Senate, then it's very optimistic outlook to be approved and legalized on the federal level. Right here, I can show you this is a map of the U.S. These states show which states are for medical use, which are fully legalized, which are just decriminalized, and which are fully legal. As you can see, there are those little white dots indicate which states IIPR has acquired properties in. So I believe Mariah mentioned before, IIPR has acquired 61 properties in a total of 16 states. So if there are 35 total that are approved and medical use is legal in, that's another 19 available to expand for IIPR. And if all 50 states get legalized, then that's another 16, it'd be 34 states. Then before we move on, I'd also like to point out the states of Colorado, Michigan, and California, which have had huge numbers in sales, especially over the last couple of months, which I'll talk about a little bit more in the next slide. So this is our second growth opportunity. We really focused on public perception of the drug because the more people perceive it as a beneficial drug, that will lead to more deregulation and hopefully more business expansion for IIPR. So currently there are 91% of US adults that support medicinal marijuana legalization. That's taken a huge turn over the past 2 decades. 20 years ago, 70% of people were against the legalization of marijuana. So historically, that's changed a lot towards today, where most people support the legalization of marijuana. Like I said before, growing public support leads to more deregulation within the states, which leads to more business expansion for IIPR. Our group thought that IIPR should concentrate on acquiring properties in states with more patients that need medical marijuana. So if you look to the bottom right chart, you can see this chart talks about medical marijuana patients per capita. If you look towards the top 4, the leading states are California, Colorado, Oregon, Michigan. IIPR currently has properties in 3 of those top 4 states, which is really beneficial for the company. I also think they should acquire properties in Oregon, because if you look to the top right chart, this is Oregon's sales over the last 4 years in the marijuana industry. As you can see, it's been on an upward trend over the past 3 to 4 years. And if you focus specifically on the months of March of this year, March 2020, you can see it's skyrocketed and gone up huge. Sales reported between the months of May and September have been over $100 million each month, which is extremely significant. So I think if IIPR can acquire properties in Oregon, I think it'd be extremely beneficial, as well as states like California, which I'd like to also bring up that I think this industry is counter-cyclical because of Oregon really growing in sales in the months of March and May throughout the pandemic, as well as states like California, which have had record high sales. In July, they had the highest record currently in July of around 350 million in sales for the industry, and that's after they just beat their previous record of around 330 million in sales in the month of March. So as you can see, like during a pandemic, when other stocks might be not doing as well, might be decreasing, this industry will continue to grow because people, during times of a recession, of a pandemic, people look towards things like alcohol. Now people are looking towards things like marijuana, which helps with anxiety, depression. It's also been known to cure, help with patients with cancer, leukemia, AIDS, Alzheimer's. Those are all currently studies right now, but so far the studies have shown that they really have helped with patients. So this industry being counter-cyclical could really help the Spellman Fund, because if other stocks might not be doing as well, this industry will continue to grow. And with that, I'll hand it off to Jaron to explain some valuation numbers.
Hey everybody, I'm Jaron. So for our valuation, our three valuations, we have the pessimistic, baseline, and optimistic. For our pessimistic, we have projected a 17% annual consistent growth rate of the medical marijuana sales, but until 2025. This was done by New Frontier Data and Global Cannabinoids. For our baseline, like we said, there's 35 current legal states, and for our baseline, we are projecting that we are hoping that they can get into all 35 states. And with that, it'll come to a 41% growth. And although we do think 35 states to get into in the next 5 years is a bit of a stretch, we are expecting more states to become legal within that time frame, which should give us more opportunity to get into. And we also expect them to expand on current existing properties and within states they're already currently in. For our optimistic, we do have all 50 states become legal, and they do get into all 50 states. We do think this is a very far stretch, but being optimistic and like talked about earlier, there is other growth opportunities other than just brand new states. We do think these are achievable for them. To go into that, we can see how we incorporated our growth rates into our EPS projections. I'll leave this up for a little bit and everybody can kind of take a look. So with those EPS projections, we did come up with a dividend discount model to help project our valuation. For our payout ratio, we do have a payout ratio of 133% because it is a REIT. They are forced to have a payout ratio of over 90% because of all the depreciation that they own. They do end up with a, They do end up with a over 100% payout ratio. The adjusted funds from operations payout ratio is 88%, which is a more realistic number. You can see the rest of our inputs. For our baseline, we come up with an NPV of 313. Pessimistic, we have a NPV of 83, and the optimistic, we do have an outstanding 866. For the PE method, we chose a 2021 projected PE ratio of 35. We, with the average industry being at 38, we do think 35 is a very safe and very modest number for them to hit. And with those EPS projections that we talked about earlier, they come with stock prices at 163 for baseline, 135 for pessimistic, and 185 for optimistic. A little bit more realistic numbers. With those two dramatic price changes, we do have a 90-10 ratio. We took 90% from the PE multiple because we thought it was a little more reasonable and didn't show such drastic changes. So that comes out to $193 12-month ratio, which is a 24% target return, with our current stock price being at $159. Our target return also included 2021 projected dividends being of $468, and we projected that to be the 24% return. For our recommendation and portfolio fit, we are recommending 3% of the fund being bought into IIPR, which is the same weight that S&P 500 holds within REITs. Our efficient frontier number, although it would count on a lot of shuffling of the portfolio, it does come out to a 4% that we should hold of IIPR within that fund, but we are still recommending 3% as we think it's safe to just match the S&P 500. This does amount to 63 shares at $159, being just over $10,000. We think IIPR is such a great induction to the Spellman Fund because currently there is no real estate within the Spellman Fund. And with that, this gives us a great opportunity to diversify the portfolio. Most of the correlations are negative, which is a great for to help diversify the portfolio. The highest correlation being Qualcomm at 0.10, and with the lowest correlation being Intel at negative 0.33. Furthermore, we think COVID has brought a lot of struggles to recent REITs, like recent real estate. So we think that IIPR is a great way to get into REITs currently, and I think this fund greatly needs it. And we'll now open this up for questions. Here's just our appendix. Thank you, guys.
Okay, good job. Yeah, before we open it up to questions, just a quick reminder for our guests, if you can do the spreadsheet ratings. And for this one in particular, the first group was a hold, so I didn't have the investment viability part there. But for this group, if you can also rate the stock itself on its investment viability. So I want to make sure each group gets an equal amount of time, so we might as well just stick to our time being over a little bit, so we can go until 3:27. So we have a little over 20 minutes for questions, and with that, I'll open it up to whoever wants to ask a question.
I'll jump in and start it off again. This is Tyler. So I've done a little investing in REITs over the years. This is a little different than what I've looked at in the past. But generally speaking, when we're talking about adding a high yielder and we're buying REITs because we like that dividend payout, what do we think about the price if interest rates rise from here? I don't know that there's a scenario where rates could go a lot lower. We could certainly stay low for an extended period of time, but how do you think this one's going to perform in a rising rate environment? That's my first question. I'll let you guys think about that for a second. And then my second question is earnings, your traditional earnings per share, the best way to look at a real estate investment property? Because I feel like from the times that I've looked at them in the past, they've used a different metric. And so maybe I'll let you guys answer it, and then I'll kind of tell you where I'm coming from on those questions.
Jaron, you're muted.
But it looked from the lip reading I could do it looked like a really good answer, Jaron.
Thank you. With the rising interest rates, it's definitely something I haven't thought about within this project. I understood that interest rates are really low right now, and it does allow for rapid expansion of a lot of companies. But I think I really don't know how to properly answer this. I think that I don't think it'll affect too much. Obviously, the rate of growth will slow down, but I still think growth is still highly achievable. I mean, medical marijuana hopefully being just newly introduced to a lot of states. I think a lot of new patients are there, and that's easy money, I think, for a company like this, that if they want to, they can just go and expand. But I guess I haven't put a lot of thought into rising interest rates. That's a lot to think about.
Just want to chime in on it, and then I'll tell you where I'm coming from.
Yeah, I know that
All right.
generally with REITs, when interest rates rise, the prices of REITs go along with it. But is kind of a different REIT, so I don't really know how would he react to that. But it would be interesting to see. Kind of like Jaron, I haven't really looked into or thought about that a lot.
So here's where I'm coming from. If interest rates go up and I'm an investor and I'm looking for fixed income, I'm looking for a yield. If rates go up, I have better, safer alternatives, government securities that have a higher yield. And it's likely that I would sell REITs and buy those higher quality instruments to pick up that yield. So you would see prices in REITs go down, and then you would see their yields go up. So yields are going to go up across the board, whether it's high quality, low quality debt. You're going to see interest rates go up, and it's price sensitive, so prices go down. So I'd be concerned there. 2, we're acquiring real estate, we're buying properties. Part of their growth is going to be funded by debt. More expensive means potentially a lower return on some of those new properties that they're acquiring over time. So not just a market, interest rate sensitivity, but also a company performance perspective. And then the first part of that question was, you'd showed PE ratios in a couple of different spots. Generally with REITs, they will use FFO, funds from operations, because real estate investments oftentimes have non-cash expenses like amortization and depreciation that aren't necessarily, that we would strip out as investors to really get a better look at the company's performance. And so that FFO number is going to be a better ratio to use or a better number to use versus earnings when you're doing your analysis. So that's what I would have used in that part of it.
Thank you. Definitely for next time.
Well, this is a comment, and by the way, I teach coming up here soon, so I need to jump off. I'm going to actually add to what Tyler said. I was actually teaching an earlier class today, just showing that REITs are negatively correlated with a metric that's called the Purchasing Managers Index. It's a survey of manufacturers. That index tends to be highly correlated with interest rates. And the correlation, I don't know if it was on an annual basis, but it was minus 0.33. And that's probably a relative return. Now, when I mentioned this to the students, I said, but real estate right now has really underperformed this year. Probably on average, they're, now your company may not, but just a normal real estate investment trust maybe have underperformed the market by 25% or so. And so possibly if the economy continues to improve and rates go up, let me ask you this, because it's off this. I agree with everything that Tyler said. But what types of REITs do you think would do well when rates go up or economy improves? It could be yours, but what reasons why would maybe real estate do well this time? What's taken these stocks down to be 25% return worse than the market this year? So think about industries real estate serves. So what type of real estate is there? Housing, but they're not part of companies, right? They're not part of
Commercial.
office, yeah.
Data centers, right?
Retail centers, yeah. So they've gotten destroyed here, right? And that's why these stocks are down. So maybe actually if the economy gets better and rates go up, this will be the one time that they're not negatively correlated with higher interest rates, because they've underperformed when interest rates were going down, remember, this time.
Okay.
And normally you would think they would do well. They're a safer asset with normal rent payments. They actually didn't act defensively this time. So maybe they act well when the economy gets better. Well, why do you think your company, if we don't own any real estate, right? You said that. So maybe this is diversifying. Why do you think your company would also possibly do better than normal when rates go up? And I'm saying normal, because normal is what Tyler said.
Well, they are in the kind of medicinal industry of real estate, which I think medical marijuana is kind of on the upside with this COVID-19 going around. I think depression is kind of increasing, and medicinal marijuana is still there to kind of medicate against that and help. So I think that would have something to do with it, if any of my
So you're basically saying they have a lot of growth, right? Where the other real estate companies could be facing higher cost of debt, but you have some growth element to offset that. Okay, I agree with that. I was hoping you would say something like that. Okay, I'm going to jump off here in a couple minutes.
Other questions?
I'm sorry, this is Bob Allen. I'm just wondering what they're going to be doing different against competition that wants to do the same thing.
That's still, I don't know if any of my other group members want to put it on this, but my opinion is I really have no idea because there is no competition currently directly in the real estate of medical marijuana growers. But if any of my group members have any input on it.
Yeah, I would say going off of that, the competition isn't very, it's not like something in the tech industry where you have a lot of like the blue chip stocks that are very like performing equally. I would say it is very like a very unique industry as it kind of incorporates the weed industry as well as the medical use cannabis industry. But one thing that it's just one small factor of maybe how it differentiates IIPR against other companies. Just doing some research, their sales leaseback structure, doing some reading. They seem to be a company that's very like flexible, and they just reading. They maintain their relationships with their tenants and the companies they partner with very well. Looks like they have a lot of flexibility within those leases, and I believe they do offer some opportunities to like expand and renew some of those leases. So I just think that might be one small factor in kind of how they can, if more companies rise up in this dual industry, this is kind of one competing edge they might be able to take, being that they have a lot of flexibility with their lease contracts.
Right, and adding to that, I read somewhere that out of all the leases they have, out of all the properties, there's like their rate is like they have a 99% occupancy rate, so which is extremely high. So obviously, all of their occupants are extremely happy with the business they're getting. Both sides are operating in good faith, obviously. So I think that number speaks for itself.
Well, I guess my point is there anything specialized about these buildings? Or can I go out and start building big buildings and go after the same business?
Well, you also have to look at the regulation side of things. There's a lot of, hoops to jump through, from a startup point. But since IIPR has already been in this for, years now, they've already had that startups. They know how to like jump through the hoops. They already know how to, establish themselves and get these properties. But, if you're a startup company trying to get this, you have to learn all the laws. You have to like go through proper regulations and proper procedures to get there. So I think it'd be difficult to start up. But now that IIPR already has it going, I think they have a pretty solid foundation.
It's a good answer.
Thank you.
Yeah, I have a question. This is Brandon. Given that this is a relatively new industry, and you spent a lot of time, talking about the growth prospects of medical marijuana and even legal marijuana, this is kind of a derivative of that. So my question is, how dependent are the actual producers of medical marijuana on a company like this to buy the real estate for them? Or is there avenues for them to just do it themselves? Have you looked into that?
I know I personally haven't looked into that at all. I guess that never really crossed my mind that they could just bypass the middle party. I guess that's really something that I'd have to look into and to know more of.
Yeah, I would agree. I haven't looked into that specifically a whole lot either. I do think that why one of these growers might want to partner with IIPR is just because of their stability and kind of experience within this industry. And I think that their goal with IIPR, it kind of helps give them some leverage and ground as far as stability within their property, since a lot of these growing conditions like are very contingent on weather and also regulations and such. So I think partnering with IIPR kind of gives them a name and a step up, and probably helps with a lot of their expenses leverage, as it's kind of it goes back into the whole system of now IIPR has leased back these properties to them, so they don't have full liability within the properties. I would say we would have to look further into a lot of the conditions that go into the leases.
Tyler, did you want to address Adam's questions? You can probably
Yeah,
state it a bit better than I can.
Sure. So I think the question, one of the board members had to drop off, but he wanted to make sure we asked. When we look at the growth projections for this particular company, obviously part of it's going to come from, I suppose, rent increases on the existing properties to the existing tenants, but at 99%, if there's any growth, it means we're acquiring additional properties. How much additional real estate acquisition is required to kind of hit those targets? How many properties are we going to have to buy every year in order to kind of stoke the fire here? Maybe said differently, how many properties they have today, and how many are we going to have to add every year?
Yeah, so currently they have 61 properties. I tried to find how much they make from each property they have, and I was gonna, and from each additional property, I was gonna, add it on until we get to that growth projection. But I was unable to find how much they make from each property. I'm pretty sure, Elijah, you had how much, it only gave data about how much they invest in each property. I don't know if you guys were able to find it, but I wasn't able to find how much specifically they make from each property so that we could get that projection.
Okay, so 61 properties today.
Mm-hmm.
And remind me of our projected growth rate.
Jane, I believe that was.
Yes, I'm sorry, just had to unmute. 41% is the baseline. And then we have 60% optimistic and then 17 at pessimistic.
And then how many years are we expecting that to continue? Because you're 60, you've got 61 properties in the portfolio.
Mm-hmm.
If you're going to grow at 17%, that means next year you've got to add 10 properties. The following year, you're going to have to add more. So that's going to continue to go. So until you have broader acceptance in different states or more available property in existing approved states,
Mm-hmm.
That growth rate becomes more and more difficult. And you're either issuing more debt to finance those properties, issuing stock to finance those acquisitions, or you're just going to see a slowdown in that pace.
Mm-hmm.
Especially if you're already 99% occupied. It'd be one thing if you said we're only 80% occupied, so our growth is going to come from A, higher occupancy rates, B, the acquisition of additional properties. So, I don't know if there's any limitation. I mean, maybe adding 17%, adding 10 new properties is nothing, and they'll do that in the first quarter. maybe adding 10 additional properties is a tall task, and 17% is a little ambitious, even in your lowercase. So, good question from Adam. That's something we need to kind of think through.
Yes.
With a real estate property going forward.
So my rough math, right, says they would need 73 more properties to get 119% growth over 5 years, right? So over 5 years, do you think they can go from, they can add 73 to their existing 61?
Well, they're a young company and they have 61 already. So
good answer, Jim.
Yeah, no, I honestly believe it's 100% attainable. There's multiple states that have fully legalized it, especially recently. There's more people accepting of it. There's huge growth opportunities, and I think IIPR, especially recently, has been taking advantage of those growth opportunities. And I believe they'll continue to over the next 5 years at least.
Yeah, and going off of that too, it's a little bit more of a further stretch to add multiple more states, properties within newer states. But I think that if they really focused on attaining more properties within the states that are already legalized for medical use or completely legalized, like for example, Minnesota has been recently legalized for medicinal use. And I don't believe we have any, IIPR has any properties within, but if they could in the future, in the next few years, look at capitalizing on maybe more properties within those states that have been within the last year legalized in some form, I think that might help add to the growth outlook.
Yeah, especially states like California, which is leading in sales right now, and Oregon, which they aren't even in yet, which is really, really booming in sales right now. I think that would be really beneficial for them.
So we have a couple more minutes. So I don't know if any other people have questions, but I guess maybe a good place to end, I'll ask a question of sort of the ESG aspect of it, right? That's something we care about with our fund here. So, you guys are the managers of this fund. So is this something you're comfortable with? We're a university student managed fund. Do you see any issues with that, sort of the moral aspect of it, or are you on the other side of it that, the support is growing and there's no stigma anymore? This is something we should be comfortable adding.
Yeah, I definitely believe, the stigma and public perception is changing to see the benefits of it. 20 years ago, you just saw it as, a drug where, people would get high and just be lazy and stuff. But now you can see the benefits of curing leukemia, helping with cancer patients, Alzheimer's, anxiety, depression, stress, all those benefits. And I think because it's specifically in the medicinal marijuana field, I think ethically it is sound.
I agree.
Okay, well, for the sake of time, we should probably end things there, but good job. So you guys can stop sharing your PowerPoint there, and we can move on to our third group, our last group for today, which would be Nexstar. Once again, our guests, if you can fill out the spreadsheet for the group that just finished up. The Nexstar group, if someone wants to share your PowerPoint.
Thanks for taking the time to listen, and appreciate it.
Yeah, thank you guys.
Okay, so just to make sure, I just got a notification that said some attendees won't be able to see it. Is that anything I should be worried about, or can anyone confirm that they can see the PowerPoint presentation right now?
I can see it.
Yep, I can see it.
Me too.
Okay.
Me too.
All right.
All right, awesome. Should we go ahead and start then?
Yep.
Yeah, go ahead.
Ready when you are.
Hi, Spellman Group, and thank you for coming. I am Dylan Sumnick alongside Chris Marshall, Nick Trowicki, and Isaac Mancini. Today, we're going to pitch you Nexstar Media Group stock, which is currently trading right around $107. Its current PE ratio is 9, and our estimated target return is 31%, which leads us to recommend a strong buy. Today, we're going to provide you with a company background, an industry overview. We'll discuss Nexstar's revenue segments, followed by a financial analysis. We'll talk about the dividend, the 4 main growth opportunities for Nexstar, the risks involved in the company, our estimated valuation, and more about the recommendation and how that fits into the Spellman Fund. Moving into the background of Nexstar, they were founded in 1996 in Scranton, Pennsylvania. Currently, they reach approximately 63% of households in the United States with their 197 stations nationwide, making them the largest local broadcasting company in the United States. Historically, a large portion of Nexstar's growth has come from mergers and acquisitions, its most recent coming from the purchase of WGN out of Chicago. We may also refer to that as Tribune Media. The sources of Nexstar's profits come from retransmission fees that stations pay Nexstar to air its programs, as well as its advertising fees. The newest form of media for Nexstar is digital media, where Nexstar currently has over 300 local mobile apps. And now I will pass that over to Isaac.
Thank you, Dylan. With Nexstar's recent acquisitions of WGN and Tribune Media, they have expanded their geographic diversity and audience reach, making them the largest television broadcasting group in the United States. Now moving forward with 197 television stations in 115 markets, reaching about 63% of all U.S. television stations, Nexstar can solidify and grow their 3 largest revenue segments, which are retransmission fees, local advertising, and national advertising.
So looking at the industry overview with Nexstar, they are the leader and the biggest company in broadcasting media. Although it's a kind of a tough industry to really define and narrow down, some of their biggest competitors are Sinclair Broadcasting, Comcast, and Omnicom, with Sinclair being their biggest competitor that operates the most similarly to them. The industry sees about a 3.5% annual growth, with about $65.2 billion in revenue each year. And the industry relies a lot on innovation, which most recently has been digital media through websites, social media, and apps.
So we did a revenue breakdown of Nexstar over their past 4 years, since Nexstar kind of works on a 4-year cycle with political advertising spiking every 2 to 4 years. And we also did this to show their revenue growth over these past 4 years. So in 2016, Nexstar had just over $1 billion in revenue, and their largest revenue source was their retransmission fees, and the second largest was local advertising. 2016 was also an election year, which is why political advertising accounted for about 9%. In 2017, Nexstar over doubled their total revenue to about $1 billion. Their retransmission compensations grew to 43% of their total revenue. Local advertising grew to 35%. You can also see that political advertising dropped to just 1%. And now in 2018, they grew their total revenue just over 13%. You can see retransmission fees and local advertising stayed pretty consistent. And once again, political advertising bumped up to 10% here. Lastly, in 2019, their total revenue was just over $3 billion. And this was right after their acquisition of Tribune Media, which is why you can see national advertising jump to 28%, overtaking local advertising as the second largest revenue source. Well, again, retransmission compensation stayed pretty consistent, and political advertising once again dropped.
So looking at some of the key financials with Nexstar and comparing it to the industry and some of their competitors, we use the S&P telecom industry to do the averages, which felt it was the best fit out of what we could find because of the industry being a little bit tough to define. You can see that Nexstar in the trailing 12 months, they've had a strong net profit margin, which is pretty close to Comcast. They also have a good ROE that's above the industry average, and it's been posting generous returns in the trailing 12 months. And looking at the past years, there's signs that's going to keep increasing. They also have a much lower PE than the industry average, which is another good sign.
When discussing Nexstar, we thought it was important to look at their dividend. While the stock is fairly undervalued, Nexstar also pays out a great dividend. Currently at $2.24 per share, their dividend payment has been increasing since 2013, when it was just 48 cents per share. Nexstar also has a dividend yield just above 2%, which beats the industry average of 1.9. Nexstar's dividend will continue to rise, as CEO Perry Sook stated in their quarterly earnings report, that cash dividends will continue to be a priority of their capital allocation. However, we do not see this being being able to grow at the same high rate simply because it's not feasible in the long run, but it's definitely going to keep increasing. You can go to the next slide. When looking at the dividends across the industry, you can see that Nexstar and Omnicom have the advantages in their payouts to the shareholders. Omnicom has been paying an increasing dividend since 2013, as well as Nexstar, which is a big reason why Nexstar and Omnicom are also selling much higher than Sinclair, for example. Next, we will look at Nexstar's growth opportunities.
So the first growth opportunity we're looking at is their local and national advertising revenues. As we talked about before a little bit with political advertising, there's usually some big jumps every 4 years and then some smaller jumps every 2 years with midterm elections. So those really drive their revenue in those years, along with professional sporting events like the Olympics that draw a lot of viewers also. In over 73% of their local newscast markets, Nexstar channels are among 2 of the top stations in viewership. And their advertising revenue grew 20% from 2019 into 2020, mostly because of the election this year. And then the next one we're going to talk about is the retransmission fees, which is another huge part of their revenue. So retransmission fees, if you don't know, they're essentially fees that local broadcast stations charge their cable customers to show their programming, all of their networks. So this is another strong growth potential for Nexstar that we looked at. We're projecting the retransmission fees to be around $2.3 billion by 2024. There's been a lot of growth over the last couple of years, but the growth has been slowing. So we tried to project that into our projections with it slowing down growth, but continuing to be strong. And then on this next slide here, this is just a graph from RSM US projecting some of their retransmission fees. You can see it continuing to increase over the coming years, with cable increasing the most, and then satellite and telecom are also still going to continue to increase. And then the third growth opportunity is their digital media. So their digital media services are local and national brands' websites, their mobile sites, their apps, and their social media accounts. In 2019, their digital revenue was around $240 million, which was around 8% of their total revenue. And then by 2024, we're projecting it to be just under $290 million, which is around a 19% growth. And if you're looking at the table on the bottom, you'll see that 2018 into 2019 actually saw a decrease in the revenue. But this was because they were rebranding and consolidating a lot of their digital media services. So this accounted for a bit of a loss. But then once all the rebranding and consolidation was done in 2019, when you're comparing the final quarters of 18 to 19, there's actually a 14.2% increase, which is a good sign for what's to come.
The last key growth opportunity for Nexstar is its mergers and acquisitions. As we mentioned before, it's Nexstar's form of their most recent growth, having large mergers with Media General and WGN in recent years. Having mergers as a source of growth is not a bad sign, considering those mergers allow Nexstar to have more sources of revenue and advancement opportunities. After merging with Media General in 2016, Nexstar saw its total revenues boosted by 1.3 billion, and EPS increased from 2.98 to 10.38 in 2017, which is also a non-election year. The recent merger with WGN is paying off well for Nexstar, as its primetime national newscast called News Nation Now is currently reaching approximately 75 million households across the U.S. And the app for News Nation Now is also proving successful and was the first to report key events from this year, such as President Trump getting COVID and the passing of Justice Ginsburg. While mergers and acquisitions can pay off, they also can have the risks associated with them, as we'll discuss in the upcoming slides.
In our risk matrix diagram for Nexstar, we identified their debt from mergers and acquisitions as their most impactful risk that Nexstar faces in the future. The second significant risk that we identified Nexstar is going to face is the risk of rising number of people cutting the cord from their cable providers. This could ultimately do for their total retransmission. However, so far Nexstar has combated their cord cutting with increased retransmission fees. And retransmission fees, as we mentioned before, are the fees that local broadcasting stations charge to their providers, and reverse retransmission fees come from affiliations such as CBS and NBC taking a cut of that retransmission fee. So more into Nexstar's debt. Nexstar has achieved a large amount of growth through their mergers and acquisitions. However, they've also achieved this by financing a large amount of debt. Currently, Nexstar has $8.05 billion in debt, with $916 million due within 12 months and another $10.5 billion due beyond that 12 months. Nexstar's interest coverage ratio is currently 2.7, meaning they are not struggling to pay off the interest on their debt from their mergers and acquisitions. And this graph here of Nexstar's historical debt is from Simply Wall Street, and we can see the large increase of debt over the years. And the most notable one is in 2019 from the acquisition of Tribune Media. And now we can see moving into 2020 how that debt is starting to decrease, while also their net worth and cash are increasing. The other significant risk Nexstar is facing is cord cutting. In 2019, 6.3 million cable subscribers cut the cord. So this number, the number of cord cutters, is continuing to rise each year. However, this rate of change is slowing. So for example, this past year, cord cutters is up 18.9%. However, compared to 2017 to 2018, that growth was 32.8%. And as cord cutters are switching to either streaming services or free local television, so Nexstar's risk is somewhat minimized, since cord cutters switch to streaming services with live television, they're still receiving those retransmission fees. And when they switch to just free local television, Nexstar can profit from increased viewers of their local stations because of their reach and size.
Okay, thank you, Isaac. So I'm going to talk about the valuation, and one of the most things initially about Nexstar was that it was undervalued. And our group believes, with our EPS projections, which I have on the next slide, that account for future growth opportunities and the revenue that they'll produce, that Nexstar will reach a target price, a one-year target price of $140.87. We considered the free cash flow to firm model more heavily, since that they acquired large amounts of debt to finance their expansion. And we felt like we should consider the debt in their target price. Our group feels that over time, this debt will pay off in the form of expansion and increase in revenues. And this is not something that we can measure momentarily, as the merger with WGN was fairly recent. These are our EPS projections, and as mentioned before, they take into account the first three growth opportunities and the revenues they are projected to generate up until the year 2025. Our group felt that Nexstar did not demonstrate a linear pattern in prior EPS results and therefore determined the projections to be cyclical. So we modeled the projections based on the cyclicality that results from election years every 2 years. And some other key metrics that we thought were worth noting were their payout ratio, which sits at 17% as of 2019, a price to book 5-year projection of 7%, and a price to earnings growth ratio 5-year projection of 1.2%. So then we did a scenario analysis and determined a baseline growth of 4%. However, as I just mentioned, that's not linear. Our pessimistic and optimistic scenarios account for 2%. Low growth will most likely occur if they don't focus on multiple ways to expand their normal business operations, and high growth will occur if they continue on their path of mergers and acquisition activities, and in addition, focus on expanding digital media, strengthening, solidifying, and expanding their business segments in national and local advertising. And brings us to our recommendation. So we suggest buying 100 shares of Nexstar, as our analysis has determined that currently their stock price is undervalued. They have multiple growth opportunities in retransmission, local and national advertising, mergers and acquisitions, and digital media eventually, and strong financials in comparison to current fund holdings and other competitors. We also feel that upper level management will be able to finance their debt accordingly over time, and looking forward, will pay a majority of that debt within 2 years. For the sake of diversification and correlation, we suggest that to counter the communication services sector allocation, that the board sell 35 shares of Disney in order to maintain that allocation percentage. The stock has potential to earn. I feel that it would bring another dimension to the portfolio. Now, talk about how this fits into the current fund.
Our first table here is what the current Spellman Fund looks like by sector weight, and the second table is what the Spellman Fund would look like with our recommendation of buying 100 shares of Nexstar, with the recommendation of selling 35 shares of Walt Disney in order to kind of maintain that portfolio allocation percentage. By buying 100 shares of Nexstar at the price of $110 a share, our base value is about $11,000. However, with selling the 35 shares of Disney and using some default cash, the communication service sector market value only rises by about $5,600, and the market weight is up to 14.71% from 13.24%, which it's at now. Here's a side-by-side comparison of the Spellman Fund with Nexstar and what the S&P 500 currently looks like for sector weights. So both these funds have technology as their leading ones. The S&P 500 has healthcare, financial services, communication services, and consumer cyclical, all in that lower double-digit percentage. So our recommendation to increase communication services to the weight of about 15% comes from the sector percent changes, which is in our next slide. So this table is showing the sector percent changes of the sectors over the past 5 years. As you can see, communication services have had good returns both in the past and currently with years to date. When compared to the financial services, which is currently the second largest weighted sector in the Spellman Fund, you can see that communication services has outperformed financial services from the year to date to over the past 5 years, and each year in between the 1 year and 3 year. Lastly, we looked at the correlation of Nexstar with the rest of the stocks in the fund. Nexstar is located at the bottom there, and you can see how their correlation is with each stock. We found no real significant correlation between Nexstar and the other stocks. However, the highest correlated stock was UNH at 0.2 0.252, and the lowest was Booking Holdings at negative 0.072. We'd like to thank you all for listening to our presentation, and we'd like to open up the floor to any questions you may have.
Okay, so anyone want to jump in with any questions?
I'll start. So I like the way you broke down the earnings forecasts with, some assumed measure of cyclicality. So we've got 2020 is an election year, 2024 is an election year. Every 4 years, we have a new record amount of spending on political advertising. So if we go back to your table, where you've got earnings per share projections in a couple of different scenarios, I just want to look at 2021, 2022, 2023 again.
Chris, you want to share that? Yeah, there we go.
Yeah, I'm gonna pull it up. Just 2 seconds. And
here's where I'm coming from. It looked like we had a pretty big fall off to like $9.88 and even $5.81 in one of those off-cycle years. And I know political advertising is a big part of it, but it looked like political advertising was only maybe 10% of the total from 20. Go to 2016 real quick. Sorry, guys.
2016 revenue segments?
Yeah, let's look at the revenue segment for a second.
Okay.
2016. So it's 9% in 2016. Okay, so now go back to that valuation table. And I guess my question is, why did we assume such a big fall off? And I know this is a tough one because of the, you can't just look back at 2017. You can't look back at 2015 because it was a much different company back then. But where'd we come up with the 581 number and the 988 number compared to a company that's going to make like $16 and something this year?
Are you talking EPS projections right here?
I'm talking yep, there you are. There's the table. 2022, okay. We're going to fall off. That number I could follow, or the 2021 and 2022. Well, no, I can't. 2022 I thought would be higher because we said, mid-cycle election. 2023 seems like a pretty big drop off. 2024 makes sense compared to 2020. So tell me about 2022 and 2023 in our analysis here.
Yeah, I think what we try to do, and this was like I had mentioned, was trying to model that cyclicality that there is there. So I think we looked at 2016, 2024, or 2020, and then tried to model that as similar as possible. And what we saw in those years was that there was a decline in 2022 and 2023, which would have been 2018 and 2019. So I think what we were trying to do there was model it according to the cyclicality, and we saw a really low number in 2019, which would be, hypothetically, the 2023 number, EPS projection. So that's kind of the approach that we took there, because there was a sharp drop from the 2018 to 2019. So
yeah, so we took our growth percentage from 4 years prior, essentially, and just so yeah, like Chris said, from 2019 over to 2013.
And you also mentioned that it's a different company today, and that's definitely true with the merger. There was actually 2 mergers between 2016 and 2019. There might have been an additional one, but I know for sure that there were 2. So we tried to model those EPS projections, assuming that the company, that Nexstar was like a 2019, 2020 Nexstar in 2016. So we tried to make things equal because that merger did add a fair amount in terms of like how, what their national reach is and how much revenue they have.
Okay. And then my other question, and we didn't talk about this, but The retransmission fees that they earn, is that the same every year based on the station? Is it also dependent on advertising fees? Do they also see a tick up in retransmission value during those political cycles? Or is that a pretty steady income stream? Back to you.
Retransmission fees have been very steady over the past years, and from especially what we saw in the earnings call, we think we'll continue to see that because they have secured long-term deals with large local companies such as Fox and CBS and companies like that. And as we mentioned in the presentation, we think we'll continue to see local channels being popular for consumers. So we do see retrans fees as continuing to be very steady.
Okay.
Other questions?
Hi, this is Casey. Can you guys hear me?
Yeah.
All right, perfect.
Yeah.
Apologize. I'm actually driving right now, so I don't suggest you do this, by the way, from a risk management perspective. And I apologize in advance too, because since I am driving, I haven't been able to actually watch the slides, but I've been listening, and I had a couple, I guess, kind of combo question on growth opportunities. You mentioned retrans fees, and the gent that was discussing those was just talking about growth, but I didn't hear. I guess I was kind of curious as to what the actual growth numbers were, and maybe it's in the slide and I just couldn't see it. Kind of what your annual growth projections on retrans is going to be, and then kind of how you came about that. That's kind of like the first step question. So, and then I'll follow up with the next one.
So with the growth over the last couple of years, it's been around, I want to say it started around 20-ish, and then it has a pretty steady decline as it goes. So it actually was, I think, right around 12% from 17 into 18. And then 18 into 19, it jumped and was 22%. So we kind of took that as just kind of an outlier year. So then for the growth, we started it in 2020 with around 12%, and then just kind of declined at what we thought was a pretty good rate, a pretty fair rate. So it was a 12% growth, 11.8%, 11, 10.3, and 9.7. So we thought that was a pretty fair growth estimation, with counting in if they have any more mergers and acquisitions, and with what's coming up in those years.
Okay, that kind of leads into my next question. Given that they've had a couple large acquisitions recently, I was kind of curious as to what your guys' kind of thoughts were around the potential for M&A moving forward, in light of, you may have heard in the news recently, and it's been quite a build-up both here and in Europe, just the antitrust drumbeat is growing louder for a number of, we'll call it, social media companies like Facebook, for example. Are there any kind of antitrust limitations within this media space that Nexstar needs to be aware of as they're kind of continuing to grow, and they are the leader in this space? So is there a certain point where the government says, you know what, we don't want you controlling the entire United States? You know, not that that's going to happen, but I'm just throwing out like the absolute tail, that at what point does the government say, you know what, this is kind of the cap? So the short question is, what opportunities are there within M&As that you guys are specifically kind of pointing to?
As for the M&A, I think right now, we didn't see anything on future M&A. I think with the recent transactions they made, right now they're really focusing on paying off that debt before they were to go out and do more. As for the antitrust things, I personally didn't see anything on that. I don't think anyone else in my group did either. If anyone else wants to comment on that.
Well, I mean, it's kind of, I don't want to say it's a bad answer, but it's a little bit of a, I don't know. I would just say that I think the government is more focused with companies like Google and Facebook as far as antitrust laws are concerned. They might not even have Nexstar on their radar as far as looking into possible antitrust issues or anything like that. But I didn't see, yeah, like Dylan said, as far as the mergers and acquisitions, there's nothing that's super prospective and out in the front about what, like if there's a new deal about to occur. Although we feel like they have the resources to continue on this path, it just depends like at what point they can make a new deal or so. And even as it is right now, they have a tremendous reach across the United States. And a lot of that has come from their ability to grow and expand through mergers and acquisitions.
Yeah,
Just to add one last thing on that. Oh, Isaac, go ahead.
our CEO recently kind of said that in the following year that they wouldn't be opposed to adding some more mergers and acquisitions, and about their debt, that they wouldn't really get into that until the following year, because this year into 2020, they're concerned more about if they do want to add more with the mergers and acquisitions until after 2021, then they're going to be kind of done with that.
Okay. I appreciate that. I'm actually kind of familiar with this company, and I was just kind of curious to see what you guys had seen on it, because I do believe there is actually a cap on the amount of market cap, I guess, space that you can have. I could be wrong there, but I think they're getting pretty close to that WGN acquisition. So I would, I guess, you want to take that offline and maybe confirm that what I'm saying is correct. Because I think it's an interesting spin, kind of on that maybe not as, to your point, it's not anything you guys have seen with the research you did. So it's something that's probably harder to find. But, again, as you're looking forward, you always got to take kind of the regulatory potential into play. And again, I understand that it was probably hard for you guys to find, but something for you guys to think of as you're kind of finishing up the semester, finishing up your paper, something you might want to dig into a little bit.
Yeah, for sure. Thank you.